minute after 1 East Coast time, so I think we'll begin. We'd like to thank you all for joining us today. We're excited about what we're going to talk about. Today is a Navocate Webit. Webit promises cool content fast in 30 minutes and on your way, except for the Q&A, which usually lasts half an hour. Our cool Webit mascot is a copyright of Navocate. Some general information before we begin here. All attendees are in listen-only mode. If you would like to ask any questions at any time during the event, you may type the questions into the Q&A window on the right side of your screen. Be sure to click the send button so that we actually get to see the question, and we will open the session for discussion at the end of the event. We are recording today's webcast, so your participation in the event represents your acknowledgement of the recording and your agreement to participate in that. Finally, this is a live event where absolutely nothing can go wrong. So with that, let's introduce ourselves, but actually we'll talk about today's participants. That's something we like to do from the United States. We have San Jose today, Grosse Pointe Woods and Schaumburg, home of Motorola. Austin, Texas, quite a few up in the Northeast, Brooklyn, New York, Flemington, New Jersey, Baltimore, Reston, Virginia, and of course in our own backyard with Tampa here, including Ocoee, I'm not sure of the pronunciation of that, and West Palm Beach. Today marks a landmark for us in terms of international participation as well. So we'd like to welcome Dornbirn, Austria, Bangalore, India, Lisbon, Spain, London, Mumbai, Sydney, Australia, and Vancouver, Canada. We will be, as I mentioned, recording today's event, so if you would like to see it at a later point in time, we can do that. So I'd like to introduce Boaz Vinogradov, who will be a presenter with me. Boaz is a former president and CEO of several technology companies. He has grown startups from 30 million to 100 million in sales and participated in 3 IPOs, or initial public offerings, from the as an exit from the inside, 2 on the 2 on the NASDAQ exchange, and 1 on the Swiss exchange. And Boaz?
Thank you, Carl. And Carl is a broker at Navocate. Carl comes from extensive experience in Fortune 500 companies, where he was both in management as well as entrepreneur of his own businesses, which he purchased and later on sold. He was an advertising executive with accounts like General Mills, Pillsbury, and McDonald's, and worked for about 8 years with Microsoft, which made him the controller over this webinar software controls. And with that.
Okay, thanks very much. And Boaz, I'm just going to mute your microphone here so that we can control the sound. So let's proceed. We'd like to do a quick overview, a sponsorship announcement of Navocate. Our company is Navocate. The word is a combination of navigation and advocate. We provide business sales and acquisitions services for privately held, entrepreneurially owned emerging companies with revenues between $33 and $30 million. We focus on the underserved segment of the market, which is above the business brokers and below the investment banks. And we focus on this area specifically because we know that entrepreneurs in this range have a difficult time finding qualified intermediaries to help them in this area, because they tend to be often too small for an investment bank and often a little bit beyond what most business brokers like to handle. So with that, let's proceed to our agenda. This is Business Valuation 101. Again, thank you all for joining us. We're going to talk about 4 approaches to business valuation. why you can't rely exclusively on a sell-side market valuation today, the importance of a buy-side valuation, a quick case history, how your business associates' valuation advice can kill your chances for a timely sale, and then we're going to open it up to Q&A. So let's dive right in. I thought because we have some international guests today, we would talk very briefly about U.S. terminology. You will hear the word EBITDA or see that. That's earnings before interest, taxes, depreciation, and amortization. It's a profitability phrase that has to do a lot with our U.S. tax code. There's a subset of that called earnings before interest and taxes, which we refer to EBIT. There's SDE or seller discretionary earnings, and that essentially is net operating income plus discretionary expenditures, or what we commonly refer to as add-backs here in the United States. So, 4 approaches to business valuation. Accredited appraisers. The second is business intermediaries. The third is do it online. And the fourth is do it yourself. So let's take a look at each of these. First of all, accredited appraiser. Let's review the advantages. One advantage is certainly certifications. Certifications like ABV, Accredited Business Valuation Specialist, ASA, American Society of Appraisers, CBA, Certified Business Appraiser, and etc. The benefit of accreditation is if you're looking for litigation support, you probably want to work with an accredited appraiser. Or if you're looking for evaluation that needs to be accepted by a bank, clearly you need to work with an accredited appraiser. Another advantage is reasonable consistency, and consistency comes from the training that an accredited appraiser gets before they approach any project. It comes from the experience that they bring to doing valuations regularly and consistently, and the reasonable comes from the fact that they will all use different approaches and obviously different weighted averages based on their own experience. So if you had 20 appraisals done from 20 different appraisers, you would get some variability, but not a lot of variability. So we call that reasonable consistency. Another advantage of using an accredited appraiser is they're going to use multiple valuation methods to value your company. They're going to look at market comps, or what we call market comparables here in the United States. How did other businesses in the similar category sell? We'll take a look at that a little bit later. They're going to look at the industry multiples based on those statistics, and they're going to use or look at a variety of approaches based on your specific situation of how to value that business, such as an income approach or a book value, price to earnings ratio, invested capital to discretionary earnings, price to EBITDA. They may look at liquidation values. So there are many, many different approaches to valuation that a certified appraiser is aware of and will know how and when to use those based on your particular situation. Another advantage is certainly documentation. You're going to get a lot of detail, validation, and support in the form of a report that may range between 50 and 100 pages, if not more. So this approach to valuation is going to give you the most documentation. Another advantage is this is an arm's length transaction. Again, that's a phrase that's used here in the United States. An arm's length transaction essentially means that the market value is determined in an open market when buyer and seller act independently without any conflicts of interest. So they're making their decisions based on a fair and open marketplace. And that's critical when you look at the next item, which is it's got to be, if you're looking for an appraisal that has to be accepted by a bank. It needs to be an arm's length transaction. And because of all of the above advantages, it's really the only one of the four methods we're going to be talking about that's accepted by a bank for loan purposes. So these are all great ideas and great reasons to work with an accredited appraiser, but there are some disadvantages. One disadvantage is time. It will take 6 to 8 weeks, perhaps longer, to get an appraisal done or evaluation done by an accredited appraiser. The cost is a disadvantage. The cost can be minimally maybe $5,000, $10,000, or perhaps even more, depending on the scope and scale of your particular project. We also list theoretical as another disadvantage. What we mean by that is your accredited appraiser will probably have a meeting with the seller, maybe one, maybe two, but most of their work, we would say 95% of their work, will be done from documents provided by the seller. So it's based on financial principles and math more than it is a personal understanding of the market, of the business over time. Another potential disadvantage is this more firepower than you may need. So when you think about doing evaluation, you have to think about what's the purpose of that evaluation. How is it going to be used? Personally, internally, externally, for a bank loan? That makes a big determination about who you decide to work with. Another disadvantage is this is primarily backward-looking. So projections will be made, certainly, but they will be made on historical information without, in most cases, evaluating the new deal structure. And that's something that we'll be talking about as we talk about business valuation. Now, the second option is working with business intermediaries. So intermediaries who are going to be doing a valuation for you, like a business broker or an M&A specialist, usually will have a large database of market comps or market comparables to work with. We also cite an advantage as adaptable to the market. And what we mean by that is because these intermediaries are working with buyers and sellers on a daily basis, they're closer to the situation and changes in the market. So as changes occur over time, there's an avenue of communication here that's more helpful in adjusting frequently. Faster results, you're probably talking about weeks instead of months. Certainly maybe low cost to no cost. Most will charge a fee. Most business intermediaries will also provide a free valuation if you decide to engage with them. And we think you get a reasonable estimate of market value, plus or minus. What that means is without the time and resources and training and cost of going through a certified appraisal program, your results are going to be more directional than they are going to be more precise than you would have with an accredited appraiser. But using this method, you can get a reasonable estimate of market value here. On the disadvantage side, very high variability in the approach. So you're probably going to get significant variability in the methodology and the math. It's not going to be as quite as disciplined as what you would get from an accredited appraiser. Likely they're going to be working with a software package if they're large enough, sophisticated enough to develop one in-house, or perhaps a third-party package. And because of the variability, you're likely to get more inconsistent results. So that goes back to our reasonable estimate of market value, but you're still going to have a certain degree of inconsistency there. Wider range of results with 5 business brokers and 5 valuations. You're going to get a wider spread with the intermediaries than you are likely to with the accredited appraisers. This may not be an arm's length transaction if the broker has an incentive for a higher sales price. Now, unfortunately, don't like to say that, but occasionally it does happen. It's something you need to be aware of. A category that's developed recently is online appraisal. And their primary advantage is they talk about it being a fraction of the cost. That usually is in the $400 to $600 range, maybe a little bit more, but a lot less than what you would pay an accredited appraiser. More and more of these online services are cropping up all the time. Faster than a speeding bullet, actually faster than an accredited appraiser. You're going to get this in days and weeks, not weeks and months. You will get some documentation, maybe 12 to 30 pages in a report, but it will be template-based. It is arm's length, so that's a relatively good thing. But on the disadvantage side, you don't really know who you're working with. You don't know who's on the back end there, who's actually doing the work, and is there any thinking, is there any interpretive work, or is it just a form that they're filling out? So for that reason, it can be a bit impersonal. What you'll see on these websites is fill out the form and upload your financial statements. The valuation is delivered Federal Express. Obviously, it's formulaic, and the reason it's formulaic is this is a high-end business model or a high-volume business model. So they're going to be cranking them through a lot more quickly than you will with some of the other options. And I think a disadvantage is I don't think any of these would be accepted by a lender. Finally, we get to the do-it-yourself category. We find a lot of business owners like to set their own price, and there are a couple of advantages. One is it doesn't cost you anything to do that. The second advantage is you may get incredibly lucky and make a good guess. Outside of that, the disadvantages tend to outweigh the advantages. It's definitely not an arm's length transaction. You're likely as a business owner not to have access to a large database of market comparables. So without the database, you're more likely to hear what's happening in the industry and set your valuation based on that hearsay data. Likely, you don't have a lot of valuation experience, so there's not a lot of judgment that you can add to interpret what you're looking at. Some business owners may have that, and that's terrific, but most probably don't. Certainly, you're probably not going to produce any documentation when you do that, and unquestionably, this will not be accepted by a lender. So those are the four areas. There is actually a fifth area, which is what about my accountant Andy, my CPA Craig, or my attorney Bernie? And there's accountant Andy working away there. Well, the answer is ask them and vet them. If they have experience doing that, if they are comfortable doing it, if they have access to data, if they have their own models and experience in doing a wide range of valuations, that is absolutely an acceptable source. So next, what we'd like to do is talk about why you can't rely exclusively on a sell-side valuation today. So let's start and look at a sell-side valuation first. We'll start with a business owner. So here's the sell side, and here's a typical seller, and he owns a factory that's somewhere in New Jersey. It's 30,000 square feet. It manufactures auto parts. It was a converted coat hanger factory, whatever the particulars are. Now we want to look at some market comps. So we want to look at other factories that are similar to that one, to the one that you want to buy. But they're all different from each other. So we make cost adjustments, positive and negative, until we reach a valuation based on how these other factories sold. That essentially is a quick overview of how a sell-side market valuation is done. The buy-side valuation starts from the other side. It starts with the buyer. The buyer here wants to buy the same factory. He has seen the sell-side comps over on the left-hand side, but he has a nagging question: will this factory be profitable for me? So he really needs a buy-side valuation analysis. And that comes from a couple of basic elements. First, what's the cash injection that he's going to make? And that tells us what the debt service is going to be, because we're going to look at the deal structure. Is there third-party conventional financing? Is the owner going to take a note? How is that all going to be structured? Plus, any buyer is likely going to build and bring in his or her own business plan to figure out what he wants to do with that factory and how he'll approach it. Now, if you look at the elements on the row here that we just looked at, this row here, we're looking at human factors here. Is he a high equity, low risk buyer? Is he a low equity, high risk buyer? Or is he somewhere in the middle? So the key point is that these decisions on the buy side are more human and psychological in nature than they are on the sell side. So all of that information needs to be put into a model, because different buyers have different strategies. So while the sell side comps act as a guideline of how similar factories have sold, those comps won't answer the specific question for this particular buyer: will this be profitable for me? Because all buyers are different. So based on the purchase price and the cash injection, we can determine the debt service, and then look at the business plan to determine if the buyer here will profit or loss from this acquisition. So that's a quick look at the sell side and the buy side. Now, our opinion is, when you look at both of these approaches and you ask the question, where do most business valuations start and stop? They primarily start and stop on the left side of the screen here, which is the sell side valuation. So it's important, extremely important, to understand that you really do need to look at both. And if you're a seller valuing your business, you have to keep in mind the sell side is historical and backward looking. The buy side is future and forward looking. The sell side valuation is more focused on the hard elements of the business and the equipment, whereas the buy side valuation is more focused on the buyer and his or her buying objectives. Sellers need to know both and look at both of these things if you're going to set a valuation price. So now let's look at the importance of a buy-side valuation model. So we talked about that a little bit, and as an example, we're going to talk about Navocate's business model or valuation model that we've developed over the last several years, which includes a database of 650 industries. So the key point there is, whatever data you look at, you need to have some data to validate the sell side and the historical statistics. Our database is not a database of individual companies. The advantage of that is it gives us meta-level statistics. Now, I know that some people say, hey, wait a minute, a company in Philadelphia is different from a company in Denver. So how can you value those companies similarly? Well, the answer is, similar companies in different locations in the same industries actually do sell for similar multiples. What's different are the assets, because the real estate in Pennsylvania is going to be very different from the real estate in Colorado. So you want to look at asset value separately. Asset value being defined as, for some quick examples here, inventory, furniture, fixture, and equipment, real estate, but also people forget to look at IP or intellectual property, including patents, copyrights, trademarks, and how valuable those are in the industry. So if you're in the media industry, for example, a copyright on a creative work is going to be valued much higher than a copyright in a marketing company that's just simply a brochure. So these are all things that you need to take a look at. So based on that, we then tune the multiples. And what do we mean by tune? Just because a database suggests that an EBITDA multiple is 4 times doesn't mean it's always 4x. So if you remember your statistics class about binomial distributions and standard deviations and all that stuff, and here is a traditional bell curve, we recall from that about 68% probability that any data point will be within 1 standard deviation of the mean, which is the dark blue on the left and the right of the center, which the center here is where your mean is. Let me clear that off. And 95% will be within 2 standard deviations. So that is the first 2. I didn't draw very well there. Let's take that off. Our first 2 standard deviations, that's where 95% of all data will be. So what? Who cares about that? Well, the point is, this is why you can't look exclusively at a sell-side valuation. Because if you have an exceptional company defined as either exceptionally good, which is over here, or exceptionally bad, which is over there, then there's a relatively high probability that that company will be outside the normal distribution or outside of the bell curve, particularly in this economy. Because if you think about when all of that data was collected, much of it was not collected over the last several years when we've had this economic downturn. So when we talk about tuning the multiples, we are evaluating the historical multiple data relative to the specific company to determine if the multiples make sense. If the numbers don't make sense, then obviously something's wrong. Don't use the numbers. So that really talks about the buy side or the sell side, but what we were really wanting to focus on here is the buy side valuation. The starting point of a buy side valuation needs to evaluate the deal structure. At its simplest, that's cash in, resulting debt, cash out, but how are the financials going to be structured? Now, we're not talking about just a simple pro forma here. But remember now, the deal structure isn't dependent on the type of factory. It's based on the person, on the buyer, on the seller, but primarily on the buyer. What's his or her risk tolerance? What is his or her leverage preferences? How much cash is available? How much do they want to put in to the deal? So you have to look at the deal structure first, and from that you can model, and what we model is the typical information like revenue, gross profit, pre-debt cash flow. But the thing that we're really looking for is we want to understand in our model what is the new owner debt service. Only when you know the debt service, which is based on the deal structure, can you accurately create a buy-side valuation. So our model gives us really the ability to do infinite number of real-world combinations, which is expressed in this formula, which is a joke. And Boaz, I'm going to open the microphone to you so that you can talk about soft criteria.
So let's give Carl a little break, but both the buy and sell side valuations literally relate to numbers. And at the bottom line is we're looking at how much profit can be added or loss can be incurred if you continue on the company's current trajectory. But there are some issues that differ from one company to another. Let's say you buy a $2 million business where the owner runs the show. If there is no management team, you are left with a problem unless you really know the marketplace as good as the owner is or does. That is not always the case, and certainly not often the case. So the availability of a management team and the processes that this management team employ in the day-to-day running of the company can be a good prediction for the buyer on how well the buyer can have the company run and continue the trajectory of the current behavior of the company without making much changes. Also, without a management team, making changes may be difficult. With a good management team, making changes may be easier. What are the financial controls? Are the financials you're looking at coming to you 3 months after the quarter, or are they coming in within a day, or you have a software dashboard that lets you know at any time what is your situation on pretty much new revenues, new orders, payments being made, receivables versus payables. Those financial controls, availability really helps you in terms of managing the new company you just purchased. The market opportunity is obviously a major issue. If you address a market that is $5 million in size, let's say Orlando market only for a given product, you cannot grow your company to 10 million without making an investment going out of Orlando or adding products or services. That's a consideration. From an investor point of view, the bigger the market opportunity, the more likely you are to go. And then we move into systems, and last, for the sake of time, risk factors. Two businesses that are equal in revenue and profit. One of them is suffering from very high risk factors, employee lawsuits, vendor lawsuits, and the entire market is moving from brick and mortar into e-commerce versus a business that has no legal issues, is already getting half his income from e-commerce, and sort of ride the market changes in terms of delivery to customers, and therefore has by far less risk factors. And, if they have a patent and a trademark registration, they yet have additional reduction. Most accredited valuations will not look into that section, the soft criteria, with enough depth and enough weight to really put the company value at a valuation that describes the future as well as it describes the past. Carl?
Yeah, great. And how do we use this? We actually collect all of this information about the company, and we weight those variables on a proprietary scale that we've developed, because we know that these variables can have an exponential impact on the company relative to its success or failure. And the combination of all three of those allows us to do extensive sensitivity analysis. Boaz, you want to comment about that?
When you look at a deal, obviously the buyer wants the price to be as high as possible, and the seller wants the price to be as high as possible, and the buyer wants it to be as low. And oftentimes this is the wrong way to look at the business. So if you run a sensitivity analysis, what if sales go up 10%? What if sales go down 20%? What if I need that much more capital to make it happen, the changes that you want to deploy? You find that there is a different price that will address risk issues and likelihood of happening in a better way. These lead usually to earn-out, to note, or if you can get certain people to stick around and commit to 3 years staying with the company because they are key employees, you might as well spend a little more coming in and guarantee as a buyer that things will go better long term. So again, deal terms create a sensitivity and you want to analyze what each one of those terms and what each one of the changes in the marketplace may cause. If the company drops in sales 50% and is still breaking even, then it's an opportunity you're more interested in than a company that with a drop of 5% in sales will not be breaking even anymore, let alone profitable. Those are things that you only come to know clearly when you run sensitivity analysis, and when we deal with a seller or a buyer, we try to run as many of those scenarios as possible to get everybody into the comfort zone of knowing what if create what result.
All right, great, thanks. Now, I am running a little bit long. I'm over my 30 minutes, but we're going to cover the last topic here, how a business associate's advice can kill a timely sale based on a real live world M&A case history. The story you are about to hear is true, only the names have been changed to protect the innocent, and if you recognize that, you're my age. So how a business associate's advice can kill a timely sale. A recent case history. We had a business that we were working on. It was a $10 million revenue business. We represented the buyer. And actually Boaz handled this with a meeting with the buyer-seller where expectations were set. Trial balloons were floated. And the expectations that were discussed was this company is probably in the 4 to 5x EBITDA range, which would value it between $3.5 to $4.5 million. Now, obviously, we had financials. We weren't just guessing in the meeting here, but also to include seller financing. The buyer term sheet that we put together was a starting point of a 4x EBITDA multiple with a 20% seller note at 6% for 3 years. A little bit aggressive on the buy side, but it's a good starting point from negotiations. We presented that to the seller's intermediary. The seller went incommunicado for 2 weeks. When he resurfaced, and based on his tribal advice or advice from his business associates, the offer was $5 million cash as a counter and no owner financing. This is actually a sixth valuation model, which we call this is what it's worth to me from the seller's perspective valuation model. So again, if you're going to sell a business, get into the numbers, get into the reality, stay away from the testosterone of what I think it's worth, and I'm not going to talk to you unless you're willing to pay what it's worth to me. So before Q&A, all participants will receive from us a Selling a Business Guide, Selling a Business Preparedness Evaluation Guide. In addition, we are going to ask you to take a quick survey through SurveyMonkey, and after you're done with that, you will receive a copy of this PowerPoint in a couple of days. And with that, we are going to now open this up for questions, and I have just unmuted Linda Smith, who is our business manager with Navocate, and she's been monitoring some questions that have come in. Linda, anything? Oh, I'm at the wrong slide. We wanted to offer you here a free valuation for business owners participating today to use the model that we talked about, and you can call Mr. Boaz Vinogradov at that number on the screen, 602-418-6682. Operators are standing by. And now let's go into Q&A. And Linda, do we have any questions?
Yes, Carl, we have a few. The first one is, how many valuations have you done?
Navocate with our model is about 3 years old, and I'd say we've done 50 to 75 valuations in that time frame. And what's interesting about it is that we learn from everyone that we do, and we see new ideas, new opportunities that we incorporate. So I guess that's one of the advantages of being able to write your own model in Excel is you can change it based on how you see changes in the marketplace.
Okay. Another question. What information do you need to do evaluation?
Boaz, you want to take that one?
No. Obviously, 3 years financials of past 3 years. The more solidified the financial are, the better. If it's audited financials, you get extra scores because these are numbers made and audited by a CPA, and therefore you can assign to them a much higher degree of reliability and truthfulness. But last 3 years financials, both P&L and last year balance sheet are required. And then we have a full questionnaire that we run face-to-face, obviously, or on the phone, because it takes more than one meeting to complete, where we search for all the possible soft items that the company has strength in or a weakness. And that's a pretty long questionnaire. You get the questions up front, so you can be prepared when we actually do it. We can do it verbally or in writing. Either way will work, preferably face-to-face, so we can get as much as the human detail into it. And then we come back to you with the first run and start asking additional questions on specifics that have a lower level of importance, but address issues that will help us make sure that the valuation encompasses all the aspects of the business. And, this account was not covered much. Cell phones for employees are covered. Are they using them this way or that way, including personal use or whatever? Sometimes it's picky, but it's better to do it before you get into a due diligence where the answers can be provided because they've been looked into before you were asked for the first time. And then we can run some business solutions in terms of the deal terms and how that can affect the price, and advise you what would be terms that will maximize, obviously, your exit price if you are a seller.
Okay, great. Linda, any other questions?
Carl, we did have a question come in. If you're an early stage company, can you perform a valuation if you don't have the 3 years financials yet?
That's a great question, and Boaz, I'm going to let you answer that one as well.
The answer is definitely yes. Definitely yes. Most of the investments angels and venture capital do are into companies that have no revenue. So over here, the questionnaire of the soft side, because we don't have financial outcomes, will be more important, and your projections and the market you are addressing and the uniqueness of the opportunity, can it be really a game changer, as many VCs like to call it? And if you're the next Facebook, you can obviously get some money without. Most of us are not. Most of the opportunities are not, but still they have value because there's a know-how, there's a business plan, and if you can show a way that you put together a team that can execute on that business plan based on your know-how, then this thing is valued more than few dollars many times. And
Boaz, you've worked with venture capital firms quite a bit. How do they go about the process of doing of course, venture capital is mostly later stage, but you still don't quite have the full revenue that you would have with a mature company.
There are a couple of things that all venture capital is looking for. The first of which is, do you really know what you're talking about? If you had an epiphany last night, you wrote a business plan on 3 pages or 25 slides, and you show up at the door, likely you're going to be pushed away because, you know what, 22,000 to 1 that you are not the next Facebook based on that. But if you come up with an idea, which most main street companies even if they are to be a billion-dollar company in 10 years, address is, do you have the 10,000 hours experience in that specific marketplace? Have you, and better yet, your management team, been involved in that marketplace for a lengthy period of time, and as a result, we can believe that you understand the customer pain, the buyer pain, better than the rest of us, and if you have an epiphany knowing the market, then we are likely to put a pass mark on your first test, which is, do you know what you're talking about? The second thing is, how big is the market you're trying to address? The bigger the market, the more likely, even with a small amount of capital, you are to capture a larger revenue size. The third point is, what's your plan? I mean, you've got a nice group of people. You really know this space that you're going to go into. The space is growing fast and is really big, but you are late to it, and you don't have a plan that addresses it. You have a plan, but the plan is really an Excel sheet with one page, no sensitivity analysis, no procedures, no explanation how and why you would attract customers and why will customers drop their current solution and move to you. Is that solution really nice to have and your salesmanship is going to make it happen? Or is it something that is a real pain and companies or individuals will jump on that solution the moment you give it to them? So these, and you know, the last one is obviously how comfortable they feel with you. Any investor wants to be comfortable and feel that they can influence the company management if a crisis is about to come, if something makes no sense. And so literally these are the 4 criteria that are common to everybody. Every investor has additional few that they add. Some like a written plan, some are comfortable with a verbal plan, but they will all add something to the mix. Again, going back to the core, the more prepared you are, the more likely you are to get money and at a better valuation, and you don't have to have revenues in order to have value.
Okay, Linda, anything else?
We have one more question. From a buyer's perspective, is the valuation the upper end of what the business is worth, or is it the asking price? Or is it the fair price and you add more?
That's a good question. And the answer to that question really depends. Let's go back to this slide. It depends on what kind of valuation or who you're looking to for evaluation. Specifically, down here at the accredited appraiser range, they come up with one number. Your business is worth $1,523,000.87. They tend to do one number here. The do it online, I don't really have any experience with that. I think the do it yourself, you tend to come up with one number. Business intermediaries, it will vary depending on what kind of software that they're using. With our model, we come up with a range. So rather than one number, which we don't think is the probability of you selling for a number that the accredited appraiser gives you is probably close to 0. So what we do with our model is we bracket the number based on all of the things that we talked about here, sell side, buy side, and the soft criteria, to come up with a range. Any other questions?
Carl, that's all we have.
Okay. All right. So thank you all for participating. Tune in to Navocate's website to see our future webinars and webcasts that we do once a month on the topic of M&A valuation and buying and selling a business in the emerging company sector. We know your day is valuable. and we appreciate your interest in Navocate. Thank you very much, and have a great day.